There really aren't a lot of surprises in this, and you have to consider these are minutes from several weeks ago at a time in which the Fed felt that we were probably on the cusp of getting a little bit more done with respect to fiscal stimulus. And so one of the key phrases I think that Steve read when he noted that they're leaving room to adjust policy accordingly. And the way I read that, I think that the Fed was kind of put into a bind. Jay Powell just yesterday said we need to make a handoff to more fiscal stimulus, and then the very same day, you have the president tweeting out that, we're done with that until after the election. And so when we think about adjusting as accordingly, that could leave the door open for perhaps a round of open-ended QE, which would certainly, that in fact may be what the market's reacting to today. The market might see a greater likelihood of that, which would be positive for risk assets. It would probably be good for cyclical value stocks. Some of the industry winners would be those that benefit from a steepening yield curve, like financials, like industrials, as well as materials. A lot of what we're seeing today in the market so far.
Well, Seth, I think yesterday Mr. Powell all but pleaded for fiscal help there, and I don't know. It seems to me that we are sort of in a world of unlimited QE. But let me ask you about this, which I think I heard Steve say, and Steve can either nod or shake his head. It sounds like those minutes said that their guidance is not a promise. And so where we talked a few weeks ago about how interest rates were likely to be at or near the zero boundary for the next 2.5, 3 years, that could change.
Yeah, no, I agree. Although I do want to echo the point on fiscal. I mean, in the minutes themselves, they said that many, and that's one of the Fed sort of technical words, many of the participants were expecting substantial more fiscal policy, and that's clearly falling apart now. And so much like what Byrne said, I mean, our forecast has had for months now that there would be an additional open-ended purchase program by the Fed, that they would shift those purchases further out the curve because they're running out of tools. And that running out of tools is precisely why Powell wanted more fiscal stimulus. But I think the optionality they want to keep is what happens if there's much more fiscal stimulus than they anticipated. We know right now it's going in the opposite direction. Or what happens if, for some other reason, the economy starts to accelerate? They want to be able to adjust when the economy gets to full employment, when inflation starts to overshoot. But I think the other part of this that's really important, I think is going to prove to be more important than the Fed realizes now, is that I think their forecast for inflation coming up to 2% at the end of 2023 is actually still a little bit on the optimistic side. They've said that they wanted an overshoot of 2%. And I think it's going to be hard-pressed if we take the last expansion to get an overshoot even in the next 3 years. So that's the other direction where I think they actually might end up making an adjustment.
Burns and Seth, we're going to wrap it up there, but I do want to give Steve the last word. Steve?
Two very quick points here, Tyler. First is the minutes say a number of participants judged that the absence of further fiscal support would exacerbate economic hardships in minority and lower-income communities. And broadly, they said the absence of fiscal support creates dangers for the economy, echoing what Powell said yesterday. The other thing is just to quickly echo what Seth said. A lot of my reporting suggests that the absence of fiscal support could mean the Fed makes a pretty major shift in the bonds that it purchases. That ultimately what it does is it takes the billions that it's spending on the short end of the curve and flips those to the long end of the curve and starts to, at some point, perhaps in response to the absence of fiscal stimulus, would end up buying more long end bonds.
Shepard Smith here. Thanks for watching CNBC on YouTube.